Hi, welcome back to Magnify Payments blog series. Today we're going to take a deeper look into dual pricing. What is dual pricing? How does it differ from surcharging? And probably the most important question is, how is this catering to a consumer's choice? Because we know when a consumer has choice, their experience goes up, right? We're also going to take a look at how rising credit card processing costs are impacting merchants negatively, and how using a good dual pricing system can help retain that margin back into the business while being transparent and catering to consumer choice. Let's get started, shall we? Dual pricing is really about giving merchants more control over one of their most persistent costs in their business. That's accepting credit card payments. It creates a clear choice for the customer while helping the merchant protect profitability. The important part of that is the pricing is presented openly and professionally before the consumer pays. This is not about creating friction at the checkout. It's about making payment options clear and allowing the customer to decide. Card payments feel effortless to the consumer. They swipe, dip, tap, or click, and the transaction is complete. But behind every one of those transactions is a cost to the merchant. One transaction may not look significant. The problem is what happens when those costs repeat across hundreds or thousands of transactions every month. Over time, small percentages become a very real drain on margin. Processing costs are not happening in isolation. Merchants are also dealing with higher payroll costs, rising inventory costs, inflation, utilities, insurance, and nearly every other operating expense. That is why this conversation matters now. When margins are being squeezed from every direction, business owners have to look more carefully at where their money is going and which expenses they may be able to manage differently. Dual pricing presents two clear prices: a lower cash price and a slightly higher card price. Both prices are shown before payment, and the customer chooses which option works best for them. That upfront presentation is the foundation of the program. The customer is not discovering an unexpected fee after deciding how to pay. They are seeing the options clearly and making an informed choice. That's what makes dual pricing transparent. Dual pricing and surcharging are often confused, but they are not the same thing. With dual pricing, both prices are presented upfront, and the customer choice is built directly into the pricing model. With surcharging, a separate fee is added after the consumer chooses to pay by card. That difference affects the customer experience, the compliance requirements, and the merchant's risk. The gas station example is familiar because consumers have understood this pricing model for decades. The most common concern we hear is, my customers are going to complain, or my customers aren't going to like that. But the real issue is usually not the price difference, it's how the program is presented. When the point of sale system clearly displays the cash price and the card price, the technology does most of the explaining. The customer sees the choice, understands the option, and stays in control. That clarity makes the entire experience easier for the merchant, the employee, and the customer. Some customers will choose cash because they simply want the lower price. Others will still choose a card because they value convenience, rewards, purchase protection, or simply prefer not to carry cash. Both choices are valid. What customers appreciate is knowing the difference before the transaction is completed. When pricing is clear, the consumer can make the decision that works best for them without feeling surprised or pressured. A successful dual pricing program depends on consistency. The prices should be clear. Employees should understand how the program works, and the explanation should be simple at the checkout experience. Customers do not need a long speech. They need to know what their options are and what they will pay. When the merchant, the employees, and the technology all communicate the same message, transparency becomes part of the customer experience. Payment processing should not be viewed as just another line item on a monthly statement. It affects cash flow, profitability, pricing decisions, and the merchant's ability to grow. When more revenue stays inside the business, the owner has more flexibility. That may mean protecting margins, improving operations, or making better long-term decisions. This is why the processing conversation should be treated as a business strategy conversation. Merchants have heard promises about saving money all the time. That noise or that language has become lost, right? The stronger question is, what could the business do if more money stayed in the business every month? That changes the entire conversation. Instead of focusing only on lowering an expense, we begin talking about capital that can be reinvested back into the business. That is where the real value becomes visible. 3% may not sound like a major number when we say it quickly, but on $600,000 in annual card processing volume, that becomes $18,000 a year. That is why merchants should look beyond the percentage. The real number is the annual impact. Once the cost is translated into dollars, the business owner can begin to understand what that money could mean for payroll, for inventory, equipment, marketing, or most importantly, growth. Recovered capital can support real business priorities. It might fund a marketing campaign, help hire another employee, replace outdated equipment, improve technology, or support expansion. For some businesses, it may simply create more breathing room in monthly cash flow. That is the shift we want merchants to understand. The conversation is not only about processing, it's about what the business may be able to do next. Dual pricing must be implemented correctly. Prices need to be visible at the point of sale. The system must be programmed accurately. Receipts must reflect that transaction properly and must be applied consistently. When these pieces all work together, they create a strong program that remains clear, accurate, and properly supported. This helps reduce merchants' risk, build customer confidence, and minimizes disputes. Dual pricing can give merchants greater financial control, stronger transparency, more working capital, and continued customer choice. But it is not a one-size-fits-all recommendation. The right decision begins with understanding the merchant's business, their customers, their volume, what technology, and their goals. SlashPay by Magnify Payments helps merchants evaluate the options and implement the right strategy and support program over time. The right pricing strategy starts with the right conversation. Let's begin with a merchant-specific review.